We have 7 of the top 8 sort of telcos in the US, and more telcos being added to the platform globally. And that creates sort of this network effect where more people are referred to the platform and more people look to join the platform. And the more people are on the platform, the more value everybody gets out of it. So it really is sort of a momentum, and it's a true platform and a true network effect.
Hello, you're watching Proactive. Bango has released its 2025 annual results this week. Joining me with more is CEO Paul Larbey and CFO Matt Wilson. Paul, Matt, very good to speak with you. I'll start with you, Matt. Full year 25 has been described as a turning point for Bango. What's fundamentally changed in the business?
Yeah, thanks, Stephen, and thank you for having us on. So I think 25 is a year where you'll see strategy clearly translating into financial outcomes. And there's sort of 3 areas that I want to sort of hammer home. And I think that's the quality of our revenue improving, the increase in profitability, which is driving positive cash EBITDA. And then there's the introduction of segmental reporting, which is driving much greater transparency and visibility for investors and our stakeholders.
With that segmental reporting, why is that important, Matt?
Yeah, so I think when everything's meshed together as part of a group, it's difficult to see the underlying drivers. So now hopefully people can see that we operate 2 distinct complementary engines. We've got our payment segment, which is our cash generative business, and we've got our subscription segment, which is our recurring revenue growth engine. So now investors will be able to see the different growth, margin, and cash generation characteristics of each business unit.
And how should investors think about the quality of revenue across those segments, Matt?
Yeah, so as I mentioned before, the key point is this is improving. So if I look at payments, you've seen an intentional shift from lower margin and higher cost of sales routes into those core routes, which are much more profitable and integral to strategy. And then in the subscription segment, we've seen a much greater proportion of the mix coming from the recurring revenue stream and less reliance on those one-off revenues. So that basically improves predictability and supports retention and higher margins.
And what does scaling the platform mean for profitability?
So as we will see, as the platform scales, you're going to see the platform economics sort of come through. So once a customer is sort of integrated, each new launch, each new service, each new increasing of usage of the platform adds very low incremental costs, and that's supporting the higher profitability that we will see from our customers in future.
Paul, what are the clearest signs that the DVM is gaining traction?
Yeah, if we look at fiscal 25, we ended the year 60% up in terms of the total number of subscriptions managed by the platform, and that's our sort of North Star metric for the relevance and importance of the DVM. And a lot of that came from existing customers, and you see that in our net revenue retention figure, which shows growth of existing customers. And we continue to maintain 0 churn in customers as well. So existing customers not churning and continuing to grow. And on top of that, we had a record number of wins in the year. We signed 12 new customers. So you put all those together, and it really gives us sort of confidence for sustainable growth moving forward.
And can you tell us why bundling is becoming such a central part of the subscription market?
Yeah, we do a lot of sort of first-party research in this, and with sort of the term that's evolving is sort of subscription fatigue, because more and more services are available through subscriptions, and it's creating, I think, a level of complexity in terms of how you sign up to these services, and then a potential sort of huge bill at the end of it. And I think customers want simpler access to these services. They want better value, and they want one place to see everything together, and that naturally drives you towards a sort of a bundling model. And I was on a panel last week with somebody from Warner Brothers, and they said, look, the only way some people will ever subscribe to our service, we realize that, is through a bundle. And so bundling is an important part for sort of everybody in the ecosystem.
What makes Bango difficult to replicate in this space, Paul?
Yeah, I mean, over the past few years, we've built a really strong platform and a really strong presence in the market, and I think it creates almost this sort of that makes it harder for anybody to sort of cross. We're deeply integrated into telcos' core bundling and then core billing, bundling, and identity services. We have over 130 content providers on the network. We have 7 of the top 8 sort of telcos in the US, and more telcos being added to the platform globally, and that creates sort of this network effect where more people are referred to the platform and more people look to join the platform, and the more people are on the platform, the more value everybody gets out of it. So it really is sort of a momentum, and it's a true platform and a true network effect.
You mentioned all those new customers, Paul, but how are existing customers contributing to growth?
So existing customers have grown really strongly, and the way generally we see it, they grow through a number of ways. They grow by bringing in more of their customers to use bundles, so adding more of their own subscribers, by existing subscribers taking on more bundles, so taking on more different services, and by sometimes we migrate services over. So quite often when we deploy the DVM, an operator may have done one or two services. They've done a direct integration with a content provider themselves. We'll launch deploy the DVM, launch the new services, and over time, those legacy services migrate onto the platform because it creates one place to manage all those subscriptions and allows the telco to sort of create these cross-party bundles. So a combination of ways: growth in number of customers, growth in number of subscriptions, and migration of new services onto it.
Where do you see the biggest opportunity from here, Paul?
I mean, telcos remain our core focus. We see a lot of headroom in terms of telcos. We have a pipeline of around 100 telcos, each of which have more than 4 million customers that are, ideal prospects for the DVM. So that's a potential 400 million more consumers onto the platform. But we're also seeing demand from other verticals as well. Banks has been one we've been working in for a period. In 25, we signed a new bank which operates in 24 different countries across Europe. We've had retailers. We announced a couple of years ago, Continente in Portugal, and then there's a few others in the US. And then other sort of consumer platforms. So we've seen connected TVs be a recent area of interest as people who were initially sold as a piece of glass to hang on our wall to consume content on want to build a long-term digital relationship with us as the customer and generate an ongoing revenue stream.
Paul, I mean, it looks like you're making great progress. Why do you think this is not reflected in the share price?
Yeah, good question. So one investor told us yesterday, said, look, if you look at Bango's finances over the past 3 or 5 years and the performance, it absolutely looks stellar. And the challenge has been when you overlay the forecast, and we've had some forecast misses, and ultimately that's we're accountable for that. But revenue's almost doubled over the last 3 years. Cash EBITDA has over tripled. Sorry, EBITDA has over tripled. Cash EBITDA is now positive. But we sort of had this challenge with forecasts, which I think we've now removed from the market in the level of forecasts that are out there, which is aided by the fact that the businesses are becoming more mature. Because during that entire period, we've also integrated a major acquisition with the Docomo digital business that gives us scale in that payments business. That's a business with 46% EBITDA margins that generated almost 11 million of cash EBITDA in 25. And at the same time, we have the digital vending machine, which is this, gradually becoming the de facto platform for bundling with 130 content providers and most of the top telcos in the US connected into it. So the business has never really been stronger. And I think if you put all that together, I think with a reset of forecast in the market, the fact that the revenue is now of a higher quality, more predictable, I think we're in a really good pace to really, close that gap between the value that the business has and the value that the market puts on it.
So what's the key takeaway then for investors from full year 25?
I think the cash EBITDA turning to positive, that's the first time we've done that since the acquisition of Docomo Digital, is a major milestone. The segmental reporting gives you that level of visibility. And as I said, you have on one side a payments business, which is very high EBITDA margins, very high cash EBITDA margins. And the DVM business, which as it grows, it itself will be cash EBITDA positive in fiscal 27. So you put those two together and you put the demand that we have across from the various customers to use those two platforms. And I think we're really well positioned for the next phase of growth.
Congratulations on a great year for the company. I hope you'll continue to keep us updated with your progress.
Thanks, Stephen.
That's Bango CEO Paul Larbey and Chief Financial Officer Matt Wilson.